All right. Hello, everyone. Welcome back to another episode of the Integrating Investor. It's been a few weeks since we've done this live. I hope you guys really enjoyed the last episode with Tony Greer. I thought it was super cool. Hang on one second here. There we go. Sorry about that. Yeah, I thought it was cool just to hear Tony's kind of process. I thought it was very integrated, actually, as he tries to really find percepts to use, right? I'm going to speak in sort of the objectivist epistemology here. He tries to find kind of pure signals, right? Actual, just things as close to pure observation as possible, and really kind of use those in his investment process. Because again, kind of we're talking about investing, the act of selection, if you all remember. So really that is a really high level concept. So really, if for those familiar, kind of we build concepts off of kind of lower level, kind of more simple concepts, but eventually all from perceptual data. So I thought that was really cool. And Jeff, I saw your super chat. I thought it was for Tony. I apologize. I hope it wasn't for me, or I didn't think it was for me. I did answer you in the comment section, Jeff. If you're listening, I hope that comment is sufficient. If not, feel free just to ask, and I will. I'll answer it here. Don't worry about hitting the super chat or not. You've been a huge supporter, and it's very much appreciated. But it's a really deep question you asked. Jeff asked about I forgot the name of it, but basically, buying and selling collectibles, is that kind of a valid investment? And he's hitting on really the core of what investment is, which is pretty interesting, which is really just making money from money. So, if you can do that consistently, if you can take money, speculate, you speculate on this memorabilia, for lack of a better word. You think you have an edge, right? You think you have a process that you can kind of do consistently, and you're willing to speculate on that, like, by all means, like, go for it. It's nothing that I have any expertise in. You'd probably be taking my money pretty regularly. So yeah, I say by all means. Also, just a reminder, like and share the show out, right? I mean, new show, trying to build an audience again. Like, hopefully you guys like it. Like, it could really help me out a lot. It would definitely help the guys over guys and gals at the ARC out a lot. Hit the like button right now, and unlike it later if if it stinks, I don't know what to tell you. Or, just come back to it and like it at the end if that's your thing. But please like it. It really, really helps. And also, if you could follow me here, all my work there on Twitter, Instagram, which, I'm not as active on, very active on Twitter. Go to the website, sign up on the email list there to get the monthly articles sent directly to your inbox. And just kind of keep up with what's going on. I don't really send anything else out, just my articles. So you don't have to worry about spam. I'm not selling anything, anyone's email address or anything. Also on the website, if you have a show topic that you really love, if you have an investor who you'd love, or even just a thinker in general who you think would be a great interview candidate, go onto the website there, integratinginvestor.com, go to the contact form, fill it out, just shoot me a form there. I'll definitely see it with interview guests, as a title. You could also email me at info@integratinginvestor.com up there too. And I'll definitely see that. So I'm pretty much a one-man show here. So don't worry about it falling through the cracks. Also, super chat, use that super chat function, and already it is hopping. MA, thank you a lot for that super chat. It's a great one. MA says, got to donate while it's worth something, and very, very appropriate for today's topic, which is inflation, right? So we will be talking about inflation on this show. Kind of change gears here from crypto. And it's another kind of topic that's rife with, kind of sloppy thinking, right? I'm not going to, I'm not going to stand here and pretend like I'm an expert on it, but it's a topic that I've dug into and just find it, a bit muddled. So I'm going to try and keep this one brief. I'm going to do probably this in two two episodes, and then I'm going to follow that one up with another really cool interview guest whom I'll announce on the next on the next show. So let's see. Without further ado, Jonathan, thank you so much for the super chat. Love you. Really appreciate your support. Appreciate everyone's support. I don't want to single anyone out, but thank you so much. So if I could get this going, we will start with the disclaimer. I don't think that there shouldn't be anything on here that applies to anything. There's absolutely no investment advice. We are just digging into the concept of inflation, but I don't know, regulations have me paranoid. I'm sure I'm not the only one. So inflation, why are we even talking about inflation, right? It's simply because inflation is just, it's back in the headlines again, right? It's been crypto for a long time, which has been great. Inflation was really, all over the place, when in the 2012 era and after, when quantitative easing and the Fed, I'll just talk about the US, the Fed was just very active, even in post-COVID environment, just a very active Fed. Inflation fears are just, they're all over the place. But so we got to ask us, so we're dealing with inflation. Is that something we should be worried about? Right now, it's pretty interesting because when you look at what's going on in the investment markets, there's been some pretty severe market moves in response to a rise in the consumer price index, right? Or CPI for sure, right? This is what most people, or some kind of flavor of the CPI index, whether it's core, non-core, PCE index, whatever it is, it doesn't matter, right? This is basically an index of some kind of basket of some defined basket of goods and services, and we track kind of the change in that. So I'm just going to call that the CPI, all that stuff, lump that in and call it CPI index for short. So as prices move in these defined buckets of goods, predefined buckets of goods and services, we call that kind of inflation. So the market, that has been on the rise lately. The market has been severely responding, right? We've seen big moves in kind of commodity prices across the board. And as a result, we see commodity price futures, right? So the investment vehicle, they've been on the rise, right? Any kind of stock related to those commodities have been on the rise. And of course, bond yields, I used the 10-year treasury as kind of the benchmark for bond yields. Those have been rising, right? And that is actually represents a sell-off in bonds, right? People are scared that inflation is coming and it's going to devalue their money today, right? So why lock yourself into a contractual stream of cash flows, right? So the market is very worried about inflation. But this is completely at odds with what the Fed is saying, right? And the Fed's FMOC statement, they said it's all transitory, right? It's just going to be here and kind of be gone pretty soon. It's just this transient kind of phenomenon. So you got the market and the Fed at odds with each other, which brings up a pretty good question. Like, well, which one is right? As an investor, we should kind of question which one of those is right. Right. So there's a conflict, and that conflict needs to be resolved. Right. And that's what I'm going to at least try and do a little bit here today, or at least kind of just kind of percolate the thinking here. Right. Now, a lot of the difference, in my view, has to do with the definition of inflation itself. Right. What is inflation? Right. What is inflation kind of actually, in a sense, or maybe even more traditionally, versus what is the market's view of inflation, right? And whether or not that's right or wrong is not really the scope of this show, but or at least this particular show, I will say, this episode. But the market's view is really what matters from a trading perspective, right? Because investing, what we are trying to do is take money today and anticipate what other people in the investment markets are doing. That is really, really the job here, right? Our price is going to go up or our price is going to go down, and those prices are only changed when people actually change them. So share my screen again with you. So this is just from the article. I think there should be a link in the description for you. There's three lines on here, right? We have the red, which is the CPI index, right? And we can see that it's really spiked up pretty recently. And also we see two other lines, right? The blue line, which is the 10-year treasury yield, and the purple line, which is a commodity and, commodity ETF, right? And those are things that seem to track the CPI, right? They seem to track inflation pretty well. And what you can see right around here, right? I hope the arrow is coming up, but right at that trough, you can see that, there we go. There we go. Nice laser pointer right here, right? We see that everything's just been up and to the right, right? Commodities are up pretty significantly, the purple line, and so are the treasury yields. Like these are pretty atypical magnitude. The moves here are pretty atypical. So, we got to ask, like, what is this? Now, again, I had mentioned, if go back to sharing, this is the Fed. The Fed says, hey, we know that the pandemic here is creating all these economic hardships across the United States, right? There's been vaccinations and progress with strong policy support, right? And economic activity looks good, right? But the sectors most adversely affected by the pandemic remain weak, but they've shown improvement, right? So inflation has risen, largely reflecting transitory factors, right? So what is the Fed saying? The Fed is saying there's been a lot of hardship. This is their opinion, I should say. There's been a lot of hardship. There's been a lot of trouble, but things have been getting better. And because they're getting better, where are we going here? Because they're getting better, this inflation will subside with time. This is not permanent. This is just transitory, right? So which is it, right? The market is scared and freaked out. And the Fed is like, all right, don't worry, all good, nothing to see. Well, I'm going to surprise you here if you haven't read the article, but I actually side with the Fed here, and kind of surprising, right? And it's not because I think the Fed is doing a great job, being a steward of the US dollar. It's rather just more definitional, right? I just think the deck is stacked against inflation. And what I mean, inflation, growth in CPI, right? And because, it's just, I think people, there's just a misunderstanding of what inflation is in the marketplace today. There is a conflation, and it's because its definition has changed over the years, but we haven't updated our thinking, right? So inflation, there was a historical view of inflation, and there's kind of a modern view of inflation, and they haven't really caught up, and we kind of use them both interchangeably, and it's pretty confusing, right? But from an investing perspective, right, as someone who was going in and trying to worry about the markets, we need to know, what the market's view matters to us, because that's ultimately what we're trading here. Now, I know what you're thinking, like, who doesn't know what inflation means, right? Like, everyone knows what inflation means, right? It's probably one of the most common kind of common financial concepts out there, even though it's pretty complex. Go to any library, and there's just books and volumes documenting all the history of inflations throughout the world and time, right? We all know about the Roman emperors who have diluted the precious metal content in their coins, right? It was 4.5 grams, when things started in the BC era, and it went down to 3.8 grams of silver per coin under Nero, and it fell, even more. And by 265 AD, there's virtually no silver in these coins anymore, because the emperors had just debased the currency so much. We've all heard stories of European kings, right? And monarchs throughout the Renaissance period who would kind of clip coins, make them smaller, or reduce the precious metal content in them as a way of debasing the currency. Right. And of course, the Weimar Republic, right? That's the post-World War I Germany period, where they were on the gold standard, and they were trying to print their way out of the inflation, but they could not do that, right? Or sorry, print their way out of debt via inflation, but obviously that did not work. And then, of course, probably my favorite sort of depiction of all inflation is right here. This is Zimbabwe, right? If anyone has seen this, right, just wheelbarrows of cash, like it's virtually worthless, right? So just doesn't mean much. And if I could stop sharing, I will. There we go. Move the laser. I don't know how. There we go. Whatever. I'm stuck with the laser pointer. Sorry, guys. So, there are just reams of academic research on inflation. There's just thousands of kind of metrics, tracking inflation, right? Like, who knows how many people trade inflation? It's just a gigantic marketplace. So there are like thousands, if not millions of eyes on this concept of inflation, right? And we all know what inflation is, right? Do you guys, you guys know what inflation is, right? I don't know. What do you think? Any thoughts out there? Right? Just throw them in the chat. Right. And inflation is important because it's this concept is the cornerstone of so many of the trading for so many assets, and whether we know it or not, right? People use it in bonds. It's very important. It's huge in commodities, right? It drives commodity values. FX currencies, right? That is sort of a real important thing in currencies, and it even impacts stocks. So kind of the four major asset classes, inflation matters. And today it's just simply not a clear concept, right? So what do I mean by that, right? I've said it a couple times. I should probably start to prove my view here a little bit. And I apologize, can't get rid of that red and laser pointer. So I tried to get fancy. But anyway, this is one research. I'm quoting some research here, just looking at inflation, and the researcher notes that it's evolved over time, right? If you look at the historical look at the origins and uses of the word inflation, arguing that although the term has become nearly synonymous with price increases, its original meaning was basically had to do with an imbalance between the quantity of money and trade needs, right? So in other words, what inflation means today is completely different than what it meant, what it's meant over time. It once meant it had this monetary debasement kind of quality, right? The Fed, the central bank or government is flooding the market with money, and it's debasing the value of its money by doing that. But today it just means price increases, and specifically kind of growth in the CPI or some other comparable metric. Now, let's see. Sorry, I'm going to have a few slides kind of all in a row. So you're going to get the slides here. So if we look back through time a little bit, let's start with Karl Menger here, right? He is one of the fathers of the Austrian economists, economic school of thought, right? One I'm very sympathetic to. I'm sure a lot of other people kind of watching this are as well. And this is just kind of looking into his view, and this is Munger in 1923, right? So now we're going back to kind of 1923 view of inflation. What Menger finds here is that he has this kind of dual concept of inflation, right? He has first, right, first it has this inside kind of, and where is it? I lost it. Sort of the inner value and the outer value of money, right? So the outer value, he's talking just about the price, right? The price that we observe. But he also is referencing this inner value, which is really kind of purchasing power, right? So that's sort of the monetary standard perspective. Moving right along kind of the Keynes, this is Keynes in 1936, kind of the general theory, right? Well, Keynes kind of is tweaking the definition, or at least his interpretation of inflation a little bit, right? Keynes is with this quote right here. He's bringing up more of he's characterizing inflation as more of a supply and demand issue, not necessarily of currency, but of kind of consumption that he's kind of calling demand, and sort of employment, right? Supply, which he kind of calls employment. So Keynes is saying any sort of kind of consumption above and kind of full employment, right? So kind of how I interpret that is any kind of demand in the economy, kind of in excess of the available supply, right? So that kind of sounds a little bit like how we use it today. It sounds like kind of some kind of like economic growth metric. And we're really seeing this in 1936. Now, moving along to one of my favorite economists, von Mises. also of the Austrian school. This is from Human Action in 1949, right? So von Mises acknowledges kind of the evolution of inflation here, how it's used in the vernacular, right? So inflation is popular. He's seeing that the inflation's popular use is actually moving away from this monetary debasement that Menger kind of had with his inside view of money, and moving more towards this more generalized view of price increases being kind of wages and commodities. So we're starting to see this evolution over time as from kind of this, for lack of a better word, kind of an intrinsic kind of value of money, which I don't like, but that's all that's coming ahead right now, to kind of just general price increases that are kind of observable. Now we can see this is also von Mises, and this is from a different paper, right? He's saying everyone knows that inflation consists of a large increase in the available quantity of money and money substitutes. Everyone also knows that a general rise in prices and wages is unavoidable and inescapable result of inflation, right? So even though von Mises in a prior example concedes that, or doesn't concede, observes that the definition is changing, he doesn't concede on the proper definition, and he's very much in the currency debasement camp. Right, he's saying that more money is created, which is kind of implied here, like in excess of production, right? So he's saying there's too much money, but doesn't kind of leaves it there. There's just too much money. What's implied in that statement, I believe, is just more money being produced in excess of production in the economy, right? Then, of course, we can't leave out, Milton Friedman, this is probably one of the most famous quotes on inflation there is, right? Inflation is always and everywhere a monetary phenomenon, right? So he had a view of Milton, this is Milton 1970, right? So Milton's view of inflation as a monetary issue it carried on into the 1970s, right? So von Mises in 49 is seeing there's this kind of mixture. Milton is carrying forward sort of the Menger view, going back to kind of, the 20s. And note that this quote, right, and I think this is very important. Note that this quote here is 1970. This is before Nixon broke the dollar's link to gold in 1971, right? This is still when we had a gold standard, and there was what I would call kind of an objective monetary standard, that objective being that observable monetary standard as opposed to pure fiat money. So moving on kind of to today, this is the last slide here that I'll show here. This is from Investopedia. I mean, I'm not saying they're any kind of authority, but definitely will give us a sense of the popular use of inflation, right? This is Investopedia's definition, right? So basically what Investopedia observes here is they're saying it's a decline of purchasing power over time, right? That sounds pretty Austrian, right? Pretty Menger, right, to us. But it's estimated using an average price level of a basket of goods and services. Well, that sounds a little bit different, right? So we're trying to get this debasement using estimating it using an average price basket of goods, right? An average price of the CPI. Now that's raises some flags to me, because that is different, right? And why this is important is there are a couple assumptions in this statement that I don't know how many people actually pick up on it, right? The first assumption there is that this basket, right, whatever the CPI basket is, it's representative of everything, right? Now, this is heated debates here all the time in terms of whether or not that basket is representative, and look at the inflation, deflation, to use modern terms, of all the different, how those are rising within sort of the currency basket, right? Look, rent is going up and healthcare is going up by so much. You're telling me there's no inflation because consumer electronics are down? So there's an assumption that whatever those baskets are sort of representative. There's also an assumption there that the rise in that average price reflects the general price, right? Like, think of that for a second, right? The rise in the average right? So the average is reflecting the general, right? Really, how I read that is that all is the same as average, and that is very wrong, right? And if you go back to Menger, the inside view, right, where it's a currency debasement, that would apply to anything measured against money. Whereas now we're talking about, well, you know, on average, the average price, on average, there's, the prices are going up, and those are not the same, and that is very important. All right, so that was a mouthful. I'll take a little pause here. I'm I think I'm maybe halfway done. So it looks like we may go a little bit late with this one. And if I can figure out what's going on here, I will. So let me check out the super chat here. So thank you, MA. Again, I thank you. Looks like you're on there a couple times, and you said we little old ladies worried about inflation. I mean, you know, everyone should worry about inflation. Anyone producing anything should worry about inflation. This impacts us all. Jonathan, thank you. MA again. Is inflation an increase in the money supply? Did it used to be? MA, that is exactly what I'm getting at, trying to get at here, right? It is my argument here, and as you'll see, is that inflation used to be an increase in the money supply, whereas today it means average price. It means the price increase of the average price increase or decrease on a basket of goods. Now, whether or not that has to do with the money supply is really debatable, and I think that's what we're seeing today in the COVID environment, or the post-COVID lockdown environment. Bonnie, thank you so much. Bonnie asked, do regulations skew markets? I see how rising prices kill savings, but with endless conflicting factors in a regulatory economy, is prediction possible? Yes, regulations skew markets. I would say regulations really are the only thing that can skew markets. And if by markets we mean, let's define markets, right? If you mean markets as in a laissez-faire market, an area, sort of a marketplace free from force, so only based on voluntary action, right? That is a very clear definition. Then by definition, right, any force, i.e. regulation or government kind of mandate, that is an intervention in the market, right? So yes, regulations impact markets. So I hope that answers your question. Is prediction possible? Yeah, I think is prediction possible? Yeah, prediction is possible, but now you're dealing with an arbitrary component. It makes it harder, right? So if you're dealing with pure supply and demand, no force, that's hard enough, but also, that's doable. But now if you want to start bringing in, the game theory of a regulatory kind of component, I think that makes it very, very hard. All right, so I'm going to move along. Thank you for sticking with me, but I don't want to make this like a 12-part series on inflation, although maybe we will. So we just kind of went through, we saw how inflation has kind of evolved a little bit over time. The definition has evolved over time, and I guess you would say, so what, right? Like all prices, average price increases, right? They're kind of the same thing, right? Well, I would say no, because monetary debasement and the average price increases are very, very different, right? Let's think of a standard, right? All money, money is a standard, right? It is measuring value, right? It is giving us this fungible form to measure value. Something costs $20, let's say, or 20 pounds, right? That means something to everyone. Now, it doesn't necessarily mean the same thing to everyone, because we have different productive, capacities, for lack of a better word, but we all are able to sort of wrap our head around what that means to you, right? So it is very objective in that stance. So a monetary standard debasement, it is a change in that sort of monetary standard itself, right? It is how we actually measure the value. And, this is maybe controversial, but I see that a change in value, right, as ubiquitous, right? It's ubiquitous and instantaneous, right? Now, you may say, well, inflation is felt over time, even in the monetary stance, and that may be true, right? How the changes in prices filter over time just by the mechanisms of how, let's go back to sort of Weimar example, sort of the historical example of inflation, where inflation kind of trickles into the economy before it's felt everywhere. However, it is an instantaneous debasement in the standard because you have goods and services on the numerator and quantity of money in the denominator, and that's changing right when the money comes in, right? So that is implying that debasement, while it may not be seen over time, it is actually happening for all future goods and services that are produced now, and also kind of all cash flow that's going to be generated in the future, right? That's going to all be worth less in the future than it is now, right? So it is sort of this ubiquitous debasement. Now I can kind of use this. I kind of think of this in terms of length, right? If money means something and length, let's take a yardstick, for example, right? If you change the length of a yardstick, you double it, right? Well, now everything measures half as large as it did before you kind of made that change in definition of a yard, right? You debase the yard. However, you may not notice it because you may not notice that your house is now all of a sudden kind of twice as, half as big, because you're not measuring it then, right? Money and economic worth is only valued at points of transactions, right? And these transactions occur over time. There's not just a constant flow of transaction of everything, right? Transactions kind of occur when buying and selling occurs, and that may be a little bit floating, but you happy to come back to that. Now, when we talk about price increases on average, that's very, very different, right? Prices routinely fluctuate in the economy, right? Some go up, some go down. Nothing really moves together, even though some do at the same time. It's not everything moving at the same price, and it's very unique to the individual kind of good and service that we're talking about, right? So even if we see big moves in the average, like we're seeing today with like maybe lumber and some other hard commodities, it's not everything, right? There's not everything is going up in price. Like some things are coming down in price, right? The price of a television is still going down. So let's go back to Friedman, right? And thinking, well, okay, like I hear what you're saying, Seth, but like really, like who cares, right? Like big yawn, right? Well, here's like Friedman. We're going back to I'm sorry, von Mises's quote, right? And this is from 60 years ago, right? Again, so the first quote we covered, right? What people call today's inflation kind of has changed. But von Mises he says this innovation as in change, this innovation definition, right? It's by no means harmless. Right. There is no longer any term available to signify what inflation used to be, right? And used to signify, right? That change in quantity of money, that monetary standard debasement, right? This kind of new definition it leads to a lot of bad outcomes. And he's talking specifically about policy here, but from an investment perspective, it leads to a lot of bad investing, in my view, or at least faulty investing, in my view, right? So there's the root cause of this is really conflating the general price move, right, or all price movements with this average price move, right? Let's concretize that a little bit, right? Let's think of some non-monetary examples. Let's take slavery, for example, right, in the U.S., right? Let's go back to the U.S. 1960, right? And you could say, hey, that was free population, right? Everyone in the U.S., if we say everyone in the U.S. was free because we look at the average person, right? What you had is, it looked like freedom, but yet you had a whole, minority in the population who were enslaved. So all of American citizens or Americans living in America were not free. On average, Americans were free, right? Because there was no slavery on average. But there was no slavery, right? So you would be mistaken by conflating all and on average there. What about suffrage, right? The right to vote in the U.S. for women, right? They gained that in the early part of the 20th century. Women couldn't vote, before that. But you would say, oh, America is maybe democratic, right? Everyone in America votes on their leaders, right? Every adult votes on their leaders. Well, you know what? No, that was not true. Maybe on average, the average population voted because maybe there were more males. But if you included females, not everyone in the population voted, right? What about airplanes? Would you get on an airplane where that was made by a company where on average their airplanes are safe, right? Hey, come take a flight. On average, come fly Integrating Investor Airlines. On average, our flights don't crash, right? On average, everyone gets there nice and safe. Well, no, thank you. I'm looking for an airline where everyone gets there safe, right? All the airplanes are safe, right? So, this really conflation really sits at the heart of the transitory debate. Whether or not inflation is transitory, whether or not you take the Fed's view, as I do, versus if you take maybe a more that sort of a traditional, I won't say traditional, but kind of older view of inflation as a monetary debasement. I think that's what we're really looking at here, especially when we're looking at kind of the expansionary actions of central banks. So, looking at the time here, we're a bit over. I'd like to actually stick to under. So I'm going to leave it here for this week. I'm going to go check the chat here. So, if you guys have any, we'll stick around here for a few minutes. Hopefully that was interesting. So, MA, don't the philosopher kings manipulate what's in that basket? Yes, they do. The philosopher kings do manipulate what's in that basket. All right, and there's a lot of debate. Again, this sits at the heart. Like, is that basket is that kind of, it's pretty subjective, right? Who's making that basket, or at least what goes into that basket, and is that representative of all, right? And there's even debate upon which basket should you look at, right? And which philosopher kings know best. So that's yes, that is 100% a problem with kind of the inflation monitoring and definition that we have today. Let's see, does time, so Eric asks, that's a pretty interesting question. Does new money enter the economy over time, right? And I would say absolutely, right? If you have a growing now, this is, I don't want to get too off topic here. This is kind of a question of money, and I kind of have I view money, maybe a little bit heretical. It's kind of a really big topic that's not quite fully concrete in my head, but what is money? Money, I view, if you guys read John Tamny, he's got a great kind of characterization of it. I interviewed John in the show a few weeks ago called "When Politicians Panic." Definitely recommend checking that out if you have not. John is brilliant. He calls money a veil, right? Money is a veil, right? Money is really just, it's a placeholder, right? It's representative of goods and services that you want to buy, and that with what you have produced. So I have an employer. I kind of produce things for my employer. I get paid in money, right? And then, which really represents the things that I'm going to do with it, right? It's kind of this fungible, represents my production that I've kind of done and my output, but really in a fungible form that I could go take to the marketplace and and trade for goods and services. So in that sense, Eric, money hopefully, and new money hopefully enters the economy over time, because what that new money really is new production over time, right? That money is an abstraction for the amount of production that comes in over time. So long as production, so long as, my view is, so long as the quantity of money in circulation matches the production of the economy, which is not necessarily easy to calculate, then they should be the same, right? That would keep sort of your monetary standard consistent, if that makes any sense. Okay. So I will leave it here, right? So now we kind of have a sense of what we're trying to do here, right? We see that there's this conflation of a general rise in prices with an average rise in prices, and how, and in this environment now, what does that mean from an investing perspective, right? How does the average change affect the general change, and why does that matter, right? And we see that they're different, and it's evolved over time, and people don't necessarily, there's at least in the marketplace, we're treating them the same, and I think that's a mistake. So with that, I will wrap it up. again, please, just a reminder, hit that like button. I want to thank, also share it, send it out, share it. However you like to share it, very much appreciated. Use your super chat. A little bit too late now, but you join us on the next one and use it then. And thumbs up it if you can. If you liked it. This is a pretty hard topic, pretty confusing. I hope I'm making sense from that. Feel free to kind of get in that chat and hopefully I'll see it. So, I hope you're enjoying this. Hope you're enjoying the show. Again, feel free to comment or email me or kind of reach out on the website with show topic ideas or interview guests. And we're going to continue with this topic next week and get into some pretty interesting guests over the next few weeks. So with that, everyone have a great weekend, and I'll catch you on the next one. Take care.